According to supply managers in the 9 Mid-America states, how is the economy performing?
Our survey of supply managers, manufacturing supply managers in the 9 Mid-America states here at Creighton University for the month of November, the overall index dropped to 49.6. That's slightly below growth neutral from October's 51.1. But it's the sixth time this year that the index has been below growth neutral. And so it's what we're seeing in our survey is just up, above, and below the growth neutral reading. Now, we asked about the greatest economic threats to the businesses in the manufacturers in the region. Supply chain disruptions by far was the largest challenge that the manufacturers see going forward, with 38.7% indicating that that was likely to be the greatest threat to their business. Higher inflation was number two at 27.8. Then we had labor shortages at 11.1%, and then cyber threats at 5.6, and other factors at 16.8%. So all in all, there was, again, the supply chain disruptions were the biggest threat they saw. And I have to say, going forward, and it's a bit ahead of us now, is the potential Longshoremen strike for the 17 ports on the east and Gulf Coast of the U.S. That's still looming, and that's again right after the New Year's Day. Well, it'll be in the second week of January. That's a big threat to the manufacturing economy, and that's here in the U.S., here in the midsection of the country as well. Here I'll bring up the graph of the U.S. there, and the U.S. versus the Creighton reading, and in the Mid-America region. There you see it again, 49.6. Later on this morning, we'll hear the national reading, which will come out, and it's been below our number, but also below growth neutral. So things are moving, I would say, not up, not down, but more sideways than anything else. And that's not such a bad thing. With the manufacturing sector and the agricultural sector, two sectors that have not done that well this year. And of course, with President Trump's call for tariffs, that scares manufacturers and scares agricultural interests. And that's a big concern. That's what this part of the country depends upon. And that's a big issue going forward.
What were the hiring trends?
Hiring was also not good. November reading was 44.4, and that's up a bit from October's 44.2. Job growth, when you look at the overall reading for manufacturing for the U.S. since this year alone, down about 90,000 jobs, and that's little talked about, but that's about 0.7%. The U.S. economy has lost jobs, manufacturing jobs, 6 of the last 10 months. The region's only down slightly, 2,000 jobs, or about 0.2%. But the region's lost jobs for 4 of the last 5 months. So it's not that many, of course, less for the region than for the U.S. The underperformers, that would be Iowa, Minnesota, and South Dakota. The overperformers, those with positive growth, and only slightly there, would be Arkansas, Kansas, Missouri, Nebraska, North Dakota, and Oklahoma. Despite these job losses and lack of hiring in the region, labor shortages remain a big, big issue out there. Labor shortages in the manufacturing areas, particularly in rural areas of the 9-state region.
What inflation trends are you noticing?
Inflation is tamed by past measures. The price gauge rose to 56.6. That's only slightly above the 56.5 in October. I had to warn viewers and listeners, keep an eye on the month-to-month changes rather than the year-over-year. Often the media and economists will give us the year-over-year. Well, it's more important what's happened over the last several months. In the last 3 months, we've had the annualized up by 2.4% when we annualized it. The core, which excludes energy and food, up by 3.6%. So despite all the talk about meeting the goal of the inflation goal, the Fed is going to be really concerned about this reading. And I am really concerned going forward, and we'll talk about that later, but the inflation definitely remains above the Fed's target, but not as much as we saw a couple of years ago. On average, supply managers again expect input prices to grow between 5 and 6% over the next 12 months.
What is the economic outlook?
I expect the Fed to leave rates alone on December the 17th and 18th. That's their next meeting. Now, that's a bit controversial. Nationwide, it's about even. 50% say yes to a rate cut, 50% say no to a rate cut. In another survey we do here at Creighton University bankers, they recommended about 65% there recommended no rate change, leave interest rates where they are. There's real concern about reducing interest rates and contributing to inflationary pressures again. Keep an eye on the Federal Reserve's balance sheet. That's and you can go to Google and just say Federal Reserve balance sheet. That balance sheet is critical to what's happening to the money supply. And as the Fed lets these long-term Treasury bonds roll off their balance sheet, that is, allowing them to mature, that tends to reduce the money supply. And of course, that's important. Now we have to wait and see what happens there. Long-term rates will move slightly higher, in my judgment, to sideways. They're not going to move up much, but we could see mortgage rates moving up to 7% in the weeks and months ahead. Of course, that's a big factor for mortgage loans. Now, that's 7% on the mortgage loan. That would be up a bit on the 10-year Treasury. 10-year Treasury is now about 4.25%. That'll probably move up to, say, 4.4%. But again, mostly sideways, but a bit up on the long-term interest rates. The prime interest rate will remain at its current level. Keep an eye on the bond market. The bond market's where the action is, not the stock market, bond market. The yield on a 10-year Treasury, when it moves up, if it should move up to, say, as high as 4.8%, that would be a real problem. And I we'll have to wait and see, but there's a lot of things ahead of us right now. Chief among those would be the East Coast longshoremen strike, which would be a real big problem and pushing up inflationary pressures and creating supply bottlenecks. Of course, what's happening with the Trump administration coming in on January the 20th, what happens in terms of the tariffs. The president-elect is now threatening increase in tariffs on Mexico, one of our the second largest trading partner, and that would be a real big issue, and in my judgment, a real big problem because there would be a retaliation on the part of the Mexicans and retaliation from other trading partners as we raise tariffs. I do not think that is we certainly don't want to see it. Now, whether that's a threat or just a bargaining, negotiating strategy, I do not know. And I think only the president knows. And if anybody else knows what's in his head, then it won't work. In other words, that's his strategy. National ISM reading for November. Again, that comes out later on this morning. I expect it to remain below growth neutral. Price of a barrel of oil. That's a big issue now. It's coming down. Overall, the trend is downward, and that's broken below $70 a barrel. That would be good news. When the president comes in on January the 20th, look for liquefied natural gas. We'll be exporting that again. That's going to be good for the price of natural gas. The price of natural gas is likely to go up. Listen carefully to statements by the 12 voting members of the FOMC. That's the Federal Reserve Open Market Committee. And what's the price of gold? Gold is moving, had been moving up briskly. Now it's moving more sideways to up a bit, and Bitcoin as well, doing much the same. So all in all, it was a survey not telling us much more than what it's been telling us, but it was as good as I could expect our survey manufacturers. Until we meet again on the first business day of January, that is, I was about to say December, but of January in the new year. May your economic cup runneth over, and thank you.